This is the Lex Beyond podcast by Lexicon Labs. I'm Lex.
And I'm Bianca. The American dream has a math problem. For decades, the equation was, it was actually pretty simple. You go to school, you get a decent job, you buy the house with the white picket fence, you put, 10% of your paycheck into a 401k, and then you just wait.
You wait.
You wait 40 years, and then you retire comfortable. But for a massive swath of the population today, that math isn't just fuzzy. I mean, it feels completely broken. And when the safe path starts to look like a guaranteed loss, the risky path, it starts to look rational.
That is the terrifying pivot point we are staring at right now. When safety feels dangerous, danger starts to feel like a solution. And that is a very, very precarious place for an economy and a society to be.
Today, we are unpacking a really dense stack of research from Lexicon Labs that deals with exactly this tension. We're looking at a concept called financial nihilism, but we aren't just talking about why, Gen Z is betting on meme coins or why your cousin is suddenly obsessed with sports betting apps. We're going a layer deeper into this really dense analysis document they've labeled the dangerous echo.
And this is the part that frankly keeps me up at night. It's one thing for people to take risks. It's another thing entirely for them not to know they're taking them.
It's a heavy title, right? The dangerous echo. So our mission today is to show you how a systemic failure in language, I mean literally the specific words we use, has allowed gambling to be completely rebranded as investing. And I want to be super clear right off the top here. This isn't just about some shady startup's marketing team or, a guy on Twitter selling a crypto course. We are talking about a linguistic trap that has ensnared the U.S. government, federal courts, and even the academics who are supposedly studying the problem.
It is a massive failure of categorization.
Yeah.
Just a fundamental breakdown. We're living through a moment where the specific legal and financial definitions of investment definitions that have, held up for 100 years are just being eroded in real time.
And why does that matter? Why should we care about one word?
Because words shape our reality. They set our expectations. If the referee starts calling a tackle a hug, the game gets violent very, very quickly, and the players are the ones who get hurt.
I love that image, even if it's a bit brutal. Okay, so let's set the stage before we get into the heavy legal stuff. Let's talk about the mood, the vibe, I guess, of the economy in 2026.
The vibe, yeah.
If you look at the charts, the stock market, specifically the S&P 500, is historically doing fine. I mean, it's chugging along, making its highs. But if you talk to a 20-something or even a 30-something, they don't feel fine. There is this massive disconnect between the charts and the people. Why is that?
Because the charts measure asset prices. They don't measure affordability or access. A generation that feels the traditional ladder of success has been pulled up, just out of reach.
Okay, can you unpack that a little? Pulled up out of reach?
Sure. Think about it like this. If housing prices are outpacing your ability to save by a factor of 3 or 5 or even 10 in some cities, saving doesn't just feel difficult. It feels completely futile. It feels like you are shoveling water out of a sinking boat with a teaspoon. You're working, you're doing everything right, but the boat is still going down.
So it's not just impatience, because I feel like the lazy critique here, the one you see in op-eds all the time, is that young people just want to get rich quick. They don't want to work. They just want a Lamborghini tomorrow.
That is absolutely the lazy critique, and it completely misses the psychological driver. Scalen argues, and Lexicon Labs research really backs this up, that it's actually about agency. It's about having some sense of control.
Agency.
If you play by the old rules, saving modest amounts in low-risk funds, you are mathematically guaranteed to fall behind. Not maybe, not possibly. Guaranteed. You'll fall behind inflation. You'll fall behind asset appreciation in the housing market. You are, in effect, losing slowly.
And losing slowly is just... it's painful. It's like watching a car crash in super slow motion. You see it coming for years.
Exactly. So the logic shifts. If the safe route is a slow financial death, then the high-risk route, swinging for the fences with meme coins, gambling on sports, betting on election outcomes, that becomes the only place where you feel like you can exert control.
It's the only place with an up button that goes high enough.
It's a survival mechanism. They aren't looking for a 7% annual return, because 7% doesn't change their life. It doesn't get them a down payment. They're looking for a 1,000% return because, in their minds, that's the only math that buys them a life. It's the only way to catch up.
That is a profound shift in mindset. It's moving from investing for security to speculating for freedom.
That's a great way to put it.
And the research notes, they mention that these new markets, crypto prediction markets, all of this stuff, they offer something the S&P 500 simply cannot. immediacy.
Yes. The S&P 500 promises you might be comfortable when you're 65. Crypto promises you might be free next Tuesday. Now, the odds of that happening are, of course, astronomical, but the possibility exists. And when you feel backed into a corner by these massive macroeconomic forces you can't control, you take the odds. You buy the lottery ticket.
Okay, so we have this fertile ground for high-risk behavior. We have a generation that is just desperate for agency. This brings us to the absolute crux of this deep dive.
Right.
If I go to a casino in Las Vegas, I know I'm gambling. The flashing lights, the lack of clocks, the free drinks, it's all designed to tell my brain, this is a game, this isn't real life.
The environment screams warning.
Exactly. And if I lose, I blame bad luck. I blame the house edge. But the Lexicon Labs research suggests that in this new economy, that clarity has been completely erased.
This is what they call the dangerous echo. It's a feedback loop. You have a desperate consumer base looking for a way out. You have businesses that are ready and willing to exploit that desperation, but instead of calling their product gambling, which carries a stigma and a mental warning label.
Right, like a Surgeon General's warning.
The entire system has coalesced around rebranding it as investing, and that one word changes everything.
The notes use this analogy of a pillow that I found really, really disturbing, but it stuck with me.
The comfy pillow. Right. It's a perfect visual, I think. The idea is that language acts like a pillow for our anxieties. The word invest is like a soft down pillow. It feels safe. It feels responsible.
That's what adults do.
That's what adults do. So when you see that word, invest in this coin, invest in this event, your brain relaxes. You assume there are goose feathers inside, and goose feathers here means, regulatory protection, asset backing, a future, a safety net. You let your guard down because the word invest signals safety.
But in this case, what's actually inside the pillow?
Sharp teeth. You're resting your head on high-frequency, binary, zero-sum speculation. But because the label on the pillowcase says investment, you don't wear a helmet. You don't approach it with the cynicism or the risk management you would bring to a blackjack table.
You approach it with the trust you bring to a bank.
Exactly. And that mismatch, that chasm between the label and the reality is where people get slaughtered.
And the source material is pretty blunt about this. It says honesty is utterly lacking in the current marketplace. It's not just that people are taking risks, it's that they are being systemically lied to about the nature of those risks.
It is the defining deception of our financial era. The consumer is just bombarded. Invest in crypto. Invest in the outcome of the election. Invest in the weather. The word is used so loosely, so pervasively, that it has basically become a synonym for doing something with money.
Right. It's lost all meaning. If I buy a sandwich, am I investing in my lunch? If I buy a lottery ticket, am I investing in the state lottery fund? The lines are completely gone.
And that's not an accident. That is a deliberate strategy.
Okay, before we start naming names, and trust me, the list of culprits is shockingly long and includes some people you would absolutely never expect. I want to get technical for a second.
I'll do it.
We throw these words around. Investing, speculating, gambling. And I think for a lot of people, they feel like synonyms or, maybe just different shades of the same color. But according to the financial experts in our source material, is there a hard mathematical line between them?
There is a bright red line, and it has been drawn by financial theory for a century. It's not a vibe check, it's a math check. To be a true investment, an asset generally needs to satisfy two core pillars.
Okay, let's break these down. This is the toolkit our listener needs to defend themselves against this stuff. Walk us through pillar one.
Pillar one is cash flow generation. A true investment is an asset that works for you. It produces something. It generates a yield.
So it's not just sitting there.
It's not just sitting there. If you buy a farm, it grows corn or soybeans. You sell the corn, you get cash. That's cash flow. If you buy a bond, it pays you interest, usually twice a year. That's cash flow. If you buy a stock, it represents a share of a company that sells products, generates profit, and either pays dividends or reinvests that cash to grow. The asset itself produces value.
Okay, so let's test this. If I buy a gold bar and I bury it in my backyard, does that fit pillar one?
Technically, no. A gold bar just sits in a hole. It doesn't breed more gold. It doesn't write you a check. It doesn't charge rent to the worms.
Right.
You are hoping, you are speculating, that someone else will pay more for it later because of inflation or fear or some other external factor that's already moving away from investing and toward speculation. But gold has a long, complicated history as a store of value. Let's stick to the pure definition for now. An investment requires the asset to be productive.
Okay, so pillar one, it needs to pay me. It needs to work for a living. What is pillar two?
Pillar two is a margin of safety. This is a concept popularized by Benjamin Graham. It fundamentally includes the safety of your principal, the money you put in originally.
The principal. So if I put in $1,000, I should reasonably expect that $1,000 to still be there, mostly.
Correct. An investment implies that while market values might fluctuate, maybe your house is worth a little less this year than last year, the underlying asset has intrinsic value that protects your initial capital to a significant degree. The farm is still worth the land. The factory is still worth the machines. You aren't supposed to lose everything unless something catastrophic and completely unforeseen happens.
Like a meteor strike.
Like a meteor strike, exactly. It's not supposed to be a normal outcome that you lose 100% of your money.
So we have our test. 2 pillars, cash flow and margin of safety. Let's drag these modern assets into the lab and see if they pass. Let's start with the big one, the one everyone talks about, crypto.
Okay, let's look at crypto. Let's take Bitcoin as the primary example. Does it generate cash flow? Generally, no. A Bitcoin does not pay you a dividend. It doesn't pay you rent. It doesn't generate earnings. It sits on a ledger. The only way you make money is if someone else buys it from you for more than you paid.
This is what's known in economics as the greater fool theory, right?
It is, yes. You are banking on a greater fool coming along to pay a higher price. That's the entire model. So it fails pillar 1 pretty spectacularly.
And what about pillar 2, the margin of safety?
Well, because it generates no cash flow, it cannot be fundamentally valued. You can't do a discounted cash flow analysis on it because there is no cash flow to discount. Its intrinsic value, mathematically speaking, is 0.
Wow, okay.
Therefore, it fails the second pillar too. There is no margin of safety. There is no floor. If sentiment shifts, if people just decide they don't like it anymore or a new, better technology comes along, it can go to 0. We've seen coins go to 0 all the time.
So by this strict 100-year-old definition, you cannot invest in crypto. You can speculate on it, but you can't invest in it.
Correct. And I want to be super clear here. The source isn't saying speculating is evil. People speculate on all sorts of things, from art to classic cars.
Sure.
If you want to speculate on crypto with money you can afford to lose, go for it. But you need to know that's what you're doing. You need to know you are walking a tightrope without a net. The problem is when the tightrope is marketed as a sidewalk.
A sidewalk. I like that. Now let's look at the other big category mentioned in the Dangerous Echo document, which I think is in some ways even more insidious, event contracts.
Yes. Prediction markets.
Betting on whether a bill will pass in Congress or who will win an election.
They're just pure bets on outcomes.
So let's apply the test. Pillar 1, cash flow.
Does an event contract generate cash flow? It's a binary outcome. It pays out once if you win, and it pays nothing if you lose. It's a one-time event. There's no ongoing yield.
Okay. And what about pillar 2, the margin of safety?
Completely non-existent. In a binary event contract, a yes-no question, there is a risk of losing your entire capital in every single trade. If you bet yes and the answer is no, your money is gone. Not 10% gone, not 50% gone, 100% gone.
That sounds exactly like placing a bet on a football game.
Because functionally, it is. The mechanics are identical to sports gambling. You put money down on an outcome. If you are right, you win a payout. If you are wrong, the house keeps your money. There is no asset. There is no equity. There is no compounding interest. There's nothing left over.
The verdict here from the source material is pretty damning. It says, and I'm quoting, "You can speculate intelligently, but you can never invest in these asset classes."
And that distinction isn't just semantics. It's not just us being grammar nerds here. It is the only thing standing between a consumer and financial ruin. It's a disclosure problem. By calling it investing, you are implying a safety net that simply does not exist. You are misleading the witness.
So who is doing the misleading? I think this is the key question. Let's move to the next part of our dive and talk about the culprits. Because if I'm a consumer, I'm seeing the word invest everywhere. Who is putting it there?
This is where we get to the lineup. It's a long one.
We have to start with the obvious ones, right? The businesses selling these products. The research notes point to a couple of really clear case studies. Let's talk about Kalshi. Kalshi is a major player in the prediction market space.
Kalshi is huge. And if we look at their own language, their own marketing materials, the rebranding is explicit. They don't mince words about it. They're proud of it.
We have a document here. It's an explainer from Kalshi titled Working with Event Contracts from February 4, 2021. I'm going to read a quote directly from their material. An event contract is a new type of asset class that gives investors the ability to make trades.
Stop right there, just that first part. Asset class. Investors. They're immediately framing this as a legitimate financial instrument, comparable to stocks or bonds or real estate. They're putting on the suit and tie.
It goes on, and this is the one that really got me. Investing in a Kalshi market means investing in your opinion.
Investing in your opinion. Just think about how brilliant and how dangerous that phrase is. Investing in your opinion.
It's seductive.
It's incredibly seductive. It's a brilliant marketing slogan and a terrible financial reality. An opinion isn't an asset. An opinion is a hunch, it's a feeling, it's a bias. You can bet on a hunch, but you cannot invest in it. To elevate a gut feeling to the status of an asset class is, well, it's financial heresy.
They also say Kalshi is a federally regulated financial exchange that allows investors to trade directly on the anticipated outcome of future events.
See? And that's the shield. They lean so heavily on that federally regulated part. They're saying, look, the government watches us, so you are an investor, not a gambler. Gamblers go to shady offshore websites. Investors come to Kalshi.
It's a stamp of legitimacy.
A borrowed one, yes. And then they have this one. At Kalshi, we believe that event contracts can change the way investing works for millions of retail investors.
They're not even hiding it.
They are explicitly trying to redefine the word. They're not hiding it at all. They want investing to mean betting on outcomes. That's the mission.
And it's not just Kalshi. Coinbase is mentioned, too. Coinbase is obviously the giant in the room for crypto. They're the household name.
Well, Coinbase is a huge part of this echo chamber. In a recent court filing, they stated, and this is a direct quote, event contracts provide valuable investment opportunities.
Valuable investment opportunities. That sounds like something a wealth manager at Morgan Stanley would say about a diversified municipal bond portfolio.
It does. It normalizes the risk. It tells you this belongs in your portfolio right next to your retirement fund. It's just another opportunity. It's calm, it's boring, it's professional, it's a linguistic sleight of hand.
Now, the source material makes an interesting concession here. It says, essentially, look, these are ruthless businesses. They are trying to make money.
Right, and we should expect that. We expect a car salesman to tell us the car is perfect. We expect a casino to tell us we might win big. We expect companies to market themselves aggressively. That's capitalism.
The research suggests that the industry players are maybe 20% of the problem. Because deep down, we sort of have our guard up with them. We know they want our money. When I see an ad, my brain knows it's an ad.
But the other 80%,
Yeah.
the other voices in the echo chamber, that's where the real shock comes in. That's where the dangerous echo becomes deafening.
This is the part of the deep dive that really surprised me when I was reading the notes. The echo isn't just coming from the salespeople. It's coming from the people who are supposed to be the referees. It's coming from the government.
This is the unexpected parties section of the analysis, and it's deeply concerning. We're talking about Congress, regulators, the courts. The people who write the rules are using the wrong words. The call is coming from inside the house.
Let's start with the CFTC, the Commodity Futures Trading Commission. For people who don't know, who are they?
They are the watchdogs for derivatives and futures markets. They are the ones who regulate places like Kalshi. They are supposed to be the primary regulator standing between the public and market manipulation in these complex markets.
Okay, so they're the cops on the beat. And in 2024, the CFTC proposed some rulemaking. And they were trying to warn people, right? They saw the danger.
They were trying. They saw the smoke. But listen to the language they used. It's quoted in the notes. They said that these contracts could improperly signal to certain retail investors that these contracts are instruments to be used for investment purposes.
Okay, that sounds like a warning. Improperly signal.
It is, but it's so weak. It's so passive. It's bureaucratic word soup. It doesn't say, this is not an investment. It doesn't say, warning, this is gambling. It says, this might confuse people into thinking it's an investment.
It's like they're afraid to just say it.
It lacks all firmness. It treats the confusion as a possibility, not a certainty. It's a regulator trying to whisper a warning when they should be sounding an air raid siren.
But it gets worse, right? Because this isn't a new problem for them. We have to go back in history a bit. To the many moons ago mentioned in the notes, the Iowa Electronic Markets, or IEM.
Ah, yes. The IEM, the grandfather of all this. It started decades ago as an academic project at the University of Iowa. The idea was to let people bet on elections for research purposes, to see if markets were better at predicting outcomes than polls.
Okay, a noble cause, maybe.
And the CFTC had to decide what to do with them. They couldn't just let an unregulated market run wild, but they also didn't want to shut down a university experiment. So they issued what are called no-action letters.
Which basically means what?
It basically means, we see what you're doing, we probably could sue you, but we won't. So go ahead, but don't get too big.
But in those letters, the CFTC made a linguistic choice that, according to this research, haunts us to this day.
They did. In those official government documents, they wrote, and this is another quote, typically, participants invest no more than $25.
Invest.
Invest. They didn't say wager. They didn't say bet. They didn't say risk. They said invest. By using that word, the regulator, the highest authority in the land on this specific topic, validated the terminology from the very beginning.
So if the police officer calls it an investment, you can't blame the driver for thinking it's an investment.
Exactly. That was the moment the dam broke, linguistically. And the source notes point out the incredible irony of the CFTC having a future-proof initiative today. They're trying to modernize and get ahead of technology, but their foundational language is stuck in this original catastrophic error. They conceded the linguistic ground decades ago, and they've never taken it back.
It's not just the CFTC either. The SEC has its Project Crypto, which often muddies the waters by arguing over what kind of investment crypto is.
Right. You see this all the time in the news. Is it a security? Is it a commodity? The SEC spends years and billions of dollars fighting these court battles. But by fighting over the type of investment, they tacitly admit that it is an investment of some kind.
It's like arguing over whether a unicorn is a horse or a pony.
You've already admitted the unicorn exists. They aren't asking the most fundamental questions, is this investing? They're skipping right past that to the secondary questions.
And we can't leave out Congress, the legislative branch. The notes mention Tom Daschle.
Yes, the former Senate Majority Leader. This goes back to the debates on these DARPA contracts. DARPA, the Defense Research Agency, tried to set up prediction markets for terrorism events, really controversial stuff, predicting assassinations and bombings.
I remember that. It was a huge scandal.
A huge scandal. And Daschle was critiquing it, rightly so. But even in his critique on the Senate floor, the congressional record shows the language of investing being used to describe these bets. So it's baked into the legislative history.
So the legislative branch, the executive branch regulators, everyone is drinking the Kool-Aid. It's completely pervasive.
It's in the water supply in D.C.
Yeah.
And from there, it spreads to the branches we usually think of as the most precise with language.
Yeah.
The judiciary.
The courts. Segment 6. This is the one that's hard to swallow. You would think a judge, someone whose entire job is looking at the strict definition of words, would stop this. Words are their tools.
You would hope. You would really hope. But let's look at the ruling in Kalshi v. CFTC. This was a major case. The court wrote, and I'm quoting from the ruling, like other investments, some buyers trade event contracts simply to seek some financial return.
Like other investments.
Yeah.
Just slipped it in there.
Like other investments. The judge just casually grouped betting on a yes-no question into the same bucket as buying Apple stock or a U.S. Treasury bond. With the stroke of a pen, he normalized it. That phrase, like other investments, does so much heavy lifting there. It says, this is normal. This is settled.
And it wasn't a one-off. There was another case, Clark v. CFTC, this one regarding PredictIt. PredictIt is another one of these political prediction markets.
Right, and this ruling is, I think, even more fascinating and terrifying. The court described the market as allowing people to make small investments based on predicting political events.
Small investment.
And here's the kicker. The market had a cap. To prevent manipulation and, to keep it small scale, you couldn't put more than $850 into a single contract. In the gambling world, we call that a table limit or a betting cap.
Right. If I go to a Vegas casino and the blackjack table has a maximum bet of $500, that's a betting limit. No one calls it an investment limit.
But the court called this capping trader investment.
An investment cap.
An investment cap. When a federal judge calls a betting limit an investment cap, that creates legal precedent. It's not just an opinion anymore, it's case law. It tells the entire world this is a financial instrument, not a game of chance. It legitimized the whole operation in the strongest possible way.
Okay, so this is depressing. Surely the academics, the professors, the researchers, the people in the ivory tower, surely they see through this. These are the people who study markets and language for a living.
You would think. You would really, really think. But the academic echo is just as loud, if not louder. We have a draft paper mentioned in the notes by a researcher named Melinda Roth. The title of her paper is Betting on Event Contracts.
Okay, good start. Betting. I like it. It's accurate.
It's a great title. But then you read the abstract. The very first sentence. Prediction markets are considered the new frontier in investing.
An immediate contradiction in the first sentence.
The title says betting. The text says investing.
Yeah.
It's like they're using the words completely interchangeably. They don't even see the conflict. It's just stunning.
Then there's another one, Karl Lockhart. He published a paper in the Boston Law Review Journal, very prestigious. The title, Betting on Everything.
Again, a good, accurate title. He's identifying the problem.
But inside the paper, he writes that users invest real money. He refers to the CFTC regulating investments.
The lexicon notes point out the incredible double irony here. The entire thesis of the Lockhart paper is about the problem of distinguishing between investing and gambling. That is the point of his paper. And yet, in the paper itself, he falls into the exact same trap of calling the gambling investing.
Wow. It's like writing a paper about how poisonous snakes are not belts, but then constantly referring to the snake in your example as a hissing belt.
That is a perfect analogy. You're trying to warn people, but you're using the language of the thing you're warning them against. And the host observation in our notes is spot on. Instead of resolving the fire, academia is throwing gasoline on it.
Of course, because when a consumer or a lawyer or another judge sees a Boston Law Review article calling it an investment, that's the final seal of approval. If the professor calls it an investment, who am I to argue?
It becomes a circular reference. The companies quote the academics, who quote the courts, who quote the regulators, who originally listened to the companies. It's a perfect closed loop. The dangerous echo.
So we have the industry, the regulators, the courts, and the academics, all singing from the same hymn sheet, and the hymn is titled, Everything is an Investment.
And this brings us to the implications. Why does this matter? Why should our listener care if a judge uses the wrong word in a filing?
Segment 7. Let's land the plane here. What is the common mistake? When we strip away the fancy titles and the court rulings, what is the fundamental error being made here?
The error is equating making money with investing.
Say that again? I think that needs to sink in.
Just because you can make money doing something does not mean you are investing. It's a simple but profound distinction. You can make money playing poker. You can make money finding a $20 bill on the street.
You can make money robbing a bank, for that matter.
You can make money robbing a bank. You can make money selling your old clothes on eBay. These can all be profitable activities, but they are not investments. To be an investment, you need the asset to do the work. You need that cash flow and that margin of safety. If you strip those two pillars away, you are just moving money around. You are betting on price movement or an outcome.
The source material argues that regulators are, and I quote, hell-bent on driving America in the opposite direction of clarity. That's strong language.
It is, but you can see why they use it. The regulators are so afraid of stifling innovation. They don't want to be seen as dinosaurs holding back the future of finance. So instead of drawing hard lines, they try to accommodate these new technologies. They try to fit crypto and event contracts into the existing frameworks for commodities or securities.
But the pieces don't fit.
The pieces don't fit. And in trying to jam a square peg into a round hole, they are blurring the lines that were drawn specifically to protect people. They are validating the dangerous echo.
The notes call this a dangerous misstep, because it's not just about losing money, it's about not knowing the rules of the game you are playing.
It is a fundamental disclosure problem. Let's go back to your analogy, which I think was a good one. If I sell you a bottle of liquid and I put a label on it that says water, you drink it expecting hydration. You expect it to be safe.
Right.
If what's inside that bottle is actually vodka, you're going to have a very, very bad time, especially if you're about to drive a car or operate heavy machinery. You made a decision based on a false label.
And right now, the financial system is handing out bottles of vodka and labeling them investment-grade hydration.
And people are crashing. And when they crash, they wonder why their safe investment ruined them. It's because it was never safe. And it was never an investment in the first place. The label was a lie.
So what is the solution? Is there a way out of this echo chamber? Can we fix this?
The solution, according to our deep dive today, begins with something very simple but very difficult. It begins with fixing the language. We have to stop being polite about this. We have to call things what they are.
If it's betting, call it betting. If it's speculation, call it speculation.
Right. If a consumer sees an app that says, bet on the election, they approach it with a gambling mindset. They know they might lose it all. They know the house has an edge. They treat it like a Vegas trip, fun, risky, discretionary money only.
But if they see an app that says, invest in the election,
the entire frame shifts. If they see invest, they approach it with a savings mindset. They think about compounding. They think about long-term growth. They might put in money they can't afford to lose, like their rent money or their savings for a down payment. And that mismatch between the invest label and the gambling reality is where lives get ruined.
So we need to force that mental switch back to betting mode for these products.
We have to. The language has to be clear and honest.
It seems so simple on the surface, yet so difficult to change, because now, as you said, the legal precedents are set, the judges have spoken, the regulators have written their letters.
It is difficult. We aren't going to change the Supreme Court or the CFTC overnight. But awareness is the first step. Recognizing that the echo exists allows you, the listener, to tune it out. You can be the one person in the room who knows the difference, who can spot the lie.
This has been, honestly, a little unnerving and a little infuriating. It makes you realize how much we rely on these institutions to make sense of the world and how much they are failing at that specific job right now.
It is. It's a powerful reminder that authority doesn't always equal accuracy. Just because someone wears a suit or sits behind a judge's bench or works in a marble building doesn't mean they're using language correctly. Just because it's in the congressional record doesn't mean it's true.
As we wrap up, I want to leave you with a thought, a challenge, really, a kind of personal audit.
What's on your mind?
Open your phone right now if you can.
Right.
Look at your apps. Look at your portfolio. How many things in there are labeled invest but actually fail, the two pillars we talked about? How many things generate no cash flow and offer no margin of safety?
That's going to be a painful audit for a lot of people.
And then think about this. If we stripped away the word invest from the entire financial industry, just banned the word for a day, and only applied it where it strictly belongs, where there is actual cash flow and a real safety of principle, what would be left?
A lot less than what's on your screen right now, that's for sure.
A lot less.
You'd see the S&P 500, you'd see bonds, you'd see real estate, you'd see the farms and the factories and the businesses that actually make things.
And the rest of it, the crypto, the options, the prediction markets, all that other stuff.
The rest would have to find a new name. And maybe that name should just be the casino.
Watch out for the comfy pillow, folks. It's got shark teeth. Thanks for diving depth with us.
Stay safe out there.